My name is Spencer Robinson,
And I'm Austin Lower.
and we did the corporate financial report for Burger King. We couldn't find all the most current information, so most of the information we've been using is from the fiscal period 2009 and 2010.
In 1954, James McLemore and David Edgerton founded Burger King Corporation in Miami, Florida. Within the first 5 years, they had 5 Florida Burger Kings. The 5th year, they were ready to expand into a nationwide chain. They sold their company to Pillsbury in 1957. Burger King had become the 3rd largest fast food chain in the country.
After 1957, Burger King faced a lot of ownership issues. They transferred many times up top, which led into a lot of up and down years. But in 2002, they got together, and the Texas Pacific Group, Bain, Capital, and Goldman Sachs purchased the fast food company for $1.5 billion. In 2003, Burger King also hired Brad Blum, who was confronted with a lot of challenges because Burger King was going downhill before that. But he was able to increase the first monthly sales for the first time in nearly 2 years. Burger King has shown strong signs of recovery, earning $47 million through their chain profits. By 2008, Burger King had posted 16 straight quarters of growth in shares, and the growth of shares in the company had increased 32%.
Financial positions of Burger King. Between 1954 and 1967, Burger King had its boom because of franchising, and it was worth $18 million. The sales fluctuated until 2005 because of rapid turnover and the constant change throughout the CEO position. Between 2005 and 2009, Burger King had seen its income increase because of the Greg Brenneman adopting new approach.
Burger King has over 34,000 employees with over 13,000 locations that operate in 91 countries and territories. Burger King has 2 segments, with one in fast food and industry, and also one with the sit-down industry. Most people don't know that Burger King do have some restaurants that offer a sit-down restaurant that does serve some type of beer. Both of the segments, money ends up going back to the Burger King Corporation.
Now, there are 5 ratios. The first one is current ratio, and it is the liquidity ratio that measures a company's ability to pay short-term and long-term obligations. Current ratio in millions for 2009 is 371 divided by 482, which is 0.76. Current ratio in millions for 2010 is 434 divided by 473, which is 0.92. Burger King's current ratio for 2009 is 76 mil. This means that they are not able to pay their short-term debts.
The second one is solvency, which is debt to equity. This measures the company's financial leverage. Owners prefer a high ratio because it maximizes ROIs by using debt. Creditors prefer a low ratio because it demonstrates lower liabilities. Total liabilities in 2009 are in billions, and it was 1.73 divided by 0.975, which equals 1.7. Total liabilities in billions for 2010 was 1.62 and 1.13, which equals 1.14. Both of these numbers show that Burger King is a capital-intensive company, and they've been aggressive in financing using debt. The shareholders of this company will benefit from this high debt-equity ratio, but Burger King's earnings have fluctuated in the past couple of years.
Number 3 is activity, which is working capital. Working capital in millions for quarter 1 is negative 93. For quarter 2, it's negative 86. For quarter 3, it's negative 75. And for quarter 4, it's negative 39. Burger King's working capital continues to increase steadily for the most part. It has not taken a big loss or gain in the last 4 quarters, including the first quarter of 2017. They continue to strive for greatness. Also, working capital calculates how effectively a company is using its working capital to generate sales. Owners prefer a high working capital, while creditors prefer a low one.
So the fourth one is profitability, which is profit margin. This is an overall measurement of management's ability to generate sales and control expenses. So this net income for the next ones will be in billions. So in 2009, they posted a 7% revenue net income, and then 2010 it was also 7%. Burger King has continued to increase its profit margin every year, just by a little bit those years. They're continuing to head in the right direction. In 2009, they made 7 cents as well as 2010, like I stated earlier.
Number 5 is operating labor costs. This measures the cost of labor as a percentage of sales. In billions, it was 25% in 2009. In 2010, it was 24%. Burger King's labor costs are lower than industry standards. That is true because the starting salary of Burger King is lower than a sit-down restaurant salary.
So, according to the equation, assets minus liabilities equals stockholders' equity. In 2009, Burger King stockholders received $975 million, and in 2010 they also received $1.13 billion. This means that Burger King stockholders' equity is always increasing, which is a great sign for stockholders, and hopefully in the continuing years they continue in the right direction.
Their short-term current ratio in 2009 was they were not able to pay their short-term debts because the ratio was under 1. This was not good for the company as a whole. However, in 2010 it was raised, which allows for future businesses to succeed.
And in conclusion, for solvency, Burger King's debt to equity ratio is over 1. That means they're barely growing their business with financing their own debt. However, they have built 735 new restaurants from 2005 to 2016, and as long as the equity continues to grow at a large and positive rate, stockholders will continue to be happy where they are now.
Activity working capital. Burger King's working capital is unfortunately negative, which demonstrates that their assets are less than their liabilities. However, they have continually moved forward in gaining back assets. They could be looking at a positive working capital number in the near future.
So profitability's conclusion comes to Burger King's profit margin fiscal year for 2009 was 7%, and 2010 it was also 7%. This is just a little low for restaurant profiles because restaurants want to be between 8 and 10%. Burger King did move up a little bit, however, in 2010, but Burger King needs to continue to increase their profit margins.
Let's see. Operating labor costs. Burger King's labor cost in 2009 was higher than it was in 2010. This means that their labor cost is lower than the industry. The average labor cost is 32%. Burger King had a labor cost of 25% in 2009, and in 2010 it was 24%. So they are continuing to get better.
So some recommendations Burger King should think about. With Burger King's short-term debt continue to increase substantially in the last 5 years, this means that they have been doing a lot of renovations and building for new restaurants, which happen in their short-term debt. The most important aspect for Burger King is to strengthen their reputation and continue from there.
Also, another recommendation is they've had trouble working with their working capital over the last few years. This means that the liabilities that they need to be paid within 1 year exceed their current assets. Burger King should look into downsizing their menu, and a lot of the food that they have on there they can get rid of or replace it with. Also, they should look into eliminating the least profitable items they have on their menu. This would allow them to increase their sales.
So with Burger King, they should try to increase their labor costs significantly with the minimum wage going up. In order to increase their labor efficiency, they should look into hiring some training programs so less people could do the more people's work so they could be trained on multiple things.
The future of Burger King is looking very, very bright. They have a low working capital because of their current liabilities exceed their current assets. Burger King has been able to afford, they give $1 billion to Goodwill every year, which is incredible. Also, the total amount of restaurants has gone up significantly in the last several years. Burger King plans to remain successful within their new restaurants that are being built. With this being said, they plan to take over McDonald's in the top spot of the fast food industry.
And with Burger King, that's very good for the managers and stockholders, but not as good as their creditors.